Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, questions?
Jack, tremendous. I think I learned a lot. But I've read through some of the questions, and let me see if I can find that one. But one was about currency manipulation. When we've seen this from Hank Paulson, numerous times. Timothy Geithner mentioned it. What do you feel about that? And when you're trading this, what goes through your mind thinking about currency manipulation? Seems like we're always saying something about the Chinese, and what does that mean for us traders?
Well, everybody wants to move markets and to their benefit, and we're not saying there isn't some manipulation going on, near term. But you have to keep in mind that the currency markets, there's probably $3.2 trillion crosses every day in the Forex markets. Most of that is to fund global trade and global capital flow. A lot of it, and the growing portion of it's spec, but most of it's real economic movement. The markets are really too big to manipulate in any way for any considerable period of time. It's much too big for the central banks to move these markets, and they've learned that. So manipulation at points in time in the market throughout the day during illiquid periods, sure, it may happen, but it's not a long-term problem. Ultimately, the fundamentals are drivers.
Great point. Another question about the Baltic Index. How can all the attendees actually take a look at that? I know there's been a lot of talk on that. Is there a symbol that you look at, or how can we all follow that on a daily basis?
Yeah, actually, I don't have it, but
okay,
if they
no
just
problem.
Go to Google and put in Baltic Index on the Google.
Sorry about that.
No problem. I probably should have had that available. But if they just go to Google and put that in, they'll find it and find some free charts on that.
Another question, Jack. You're talking about the spreads widening on the different countries in Europe. What do you think that means? How wide can they get before it causes tremendous stress on the euro?
I think it's causing tremendous stress now, and you're seeing some split over monetary policy in Europe at the moment. The Germans are really concerned that and you've seen the Germans are not stepping up to provide all this funding because they know it's all going to be on their back. They're the only ones left with money in Europe, and so I think there's tremendous pressure in the euro right now, and those spreads at 500, 600 basis points telling us that. One of the key things you have to remember, the euro is really set up for Germany. It created a natural and easy export, common area for Germany. Germany, the biggest exporter in the world, when everything went to the euro. So it was very beneficial for the euro for Germany, even though they subsidized a lot of it, or more than most of the other countries. Now with the change in the export models where consumers aren't buying and the massive fiscal problems developing throughout the entire region and the Eastern European countries, Germany is very, very concerned their treasury is going to be, just taken from them. And also they're saying, hey, the benefit of this euro is not here anymore. Our export markets are cratering. So that's something we have to be concerned with, and I think that's going on implicitly behind the scenes. Germany is not going to come out and say that, but I think that's part of the risk being priced in here. Germany's tiring a little bit of this euro.
Yeah, that's a great point. Mark has a question about the correlation between the dollar and the S&P. What do you think there? If you think the dollar is going to be strong, do you feel the S&P is going to be, do very, very well over this next 12 months or so?
We're mixed here. Up until recently, we've seen a direct correlation, as we show in the charts: weak dollar, strong S&P. And in the beginning of this crisis, we saw a very, very weak S&P, which S&P really is the risk thermometer for global stock markets, and stocks are the best single risk thermometer around the world. So as the S&P came off, that risk meant assets coming back to the center, to the U.S., and hiding. But lately, if you pull up the S&P and you pull up the dollar, although day to day they may be moving, S&P up, dollar down, if you look at it generally in the trend, we've seen the S&P moving up and the dollar moving up. So the correlation is changing. And keep in mind that the 1990 bull market in the dollar was very much driven by a big rally in the in the stock market. I talked about capital flows. Big stock market rallies and cheap assets tend to bring in very big foreign direct investments into a country. And if the U.S. does start to come out of this cycle, believe it or not, if we can even think we're going to ever come out of this cycle, if it does, that tells investors around the world, hey, the U.S. Fed may raise interest rates faster and more quickly, before the other major currencies. So you have a dual tailwind for the dollar. You have foreign direct investment coming in to get in the stock market. They think it's cheap because the U.S. is recovering, and they want to get positioned for long-term capital investment. And you also have the yield differential increasing in the U.S. dollar. So if the U.S. does come out of this first and the Europeans stay mired, we could start to see the correlation start to be tight on the upside between the dollar and the S&P. So it's just something we're watching because that correlation is definitely breaking down a bit compared to what it was.
Interesting. I want to remind everyone, I'm getting a lot of great comments, Jack. A lot of the attendees want to listen to this again. You could go back to the website at the ISE, and this will be archived. So if you want to, www.ise.com/FX or / I should say archives, and tomorrow morning it'll be available. So again, if you want to listen to Jack again or the whole presentation, definitely. We're going to take a couple more questions. Jenny wants to know about what do you think the effect will be on the buck if the U.S. dollar nationalized? So, I mean, I guess it's sort of two-part. One would be if you see more nationalizations in Europe and what would happen there to the euro, and more nationalization, if we end up owning 100% of Citigroup, what do you think of that?
Again, it's relative. I think we have creeping bank nationalization already, so to speak, and we're seeing it really in all the other major countries. So I think it's a relative point. If it's because of a massive crisis in the U.S. banking system relative to if the eurozone stabilizes, I think it's very negative for the dollar. But if everybody's playing the same game in order to try and stabilize the credit system, which it looks like they are, then other factors will be the driver in the background and not necessarily that.
That's great. So it's relative makes a lot of sense. John wants to know what would be the implications, and I've had some private questions on this in the last hour. What would be the implications if China refuses to buy our debt? And also, this is another question that I was thinking of. Jack, do you think the Chinese are buying these T-bills at zero? Is it the Chinese, or is it some other group, or is it just everyone that's so afraid to go out in duration that they're all buying Treasury bills at a zero interest rate?
I think it's a little bit of everybody, but remember that the U.S. consumer, which is saving, and major investors that are saving, are buying Treasury bills at zero because they believe in the return of capital at this stage as opposed to the return on capital. As to China, this has been a scenario that's been in the market that newsletter writers have loved for many, many years. China's going to sell off our bonds, blah, 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 blah. I don't mean to belittle it, but I do belittle it because, number one, it's been the best single investment for China for the last year. If they bought U.S. Treasuries, they've gone up massively, and the U.S. dollar has gone up 25%. Number two, U.S. consumer is still the driver of all Chinese exports and most of their growth. If they crush the U.S. consumer by selling off their Treasury bonds, they cut off their nose to spite their face. Number three, what are they going to do with the rest of their capital? They can't put $1 trillion in the Malaysian bond market. The U.S. Treasuries are the deepest market that they can hide in. There's been a very big symbiotic relationship between the U.S., the funding from China, but it is breaking down.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.